Good afternoon, everyone. Welcome to Capital Management Corporation's Market Outlook webinar. This is Scott Davila. I'm Vice President of Marketing and Client Relations. And with me today is Tim Call, President and Chief Investment Officer of CMC, and Mark Livesay, Vice President and Senior Portfolio Manager. Couple housekeeping things that I wanted to make note of. If you have a question, you'll see on your menu down below with a caret, it says questions. You can click on that caret. It'll drop down where you can type in your question and send it to us. We've already got a couple prior to this webinar, but we encourage you to go ahead and ask questions through that mechanism. And the second thing is we are recording it. So if you want to go back and listen to it again, we'll put it up on our website no later than Monday. So let's get started. Today's key themes are market volatility, which we're seeing again today. We're going to talk a little bit about the midterms elections because that's been top of mind for a lot of people, and it's quickly advancing towards the election date. And Tim at the end is going to talk about long-term opportunities with the market that we're currently facing. So with that said, I'm going to pass it over to Mark.
Thank you, Scott. What a day to talk about volatility. Early this morning, the futures were up roughly 300 to 400 points. At 8:30, the new inflation data was released, and they quickly fell to roughly down 300 or 400 points. At the open, the market fell about 600 points, and when I walked in here, it was up about 600 points. So we've had a Dow range today of roughly 1,260 points, or over 4%. So that just shows how difficult it is in the short term to time the market. This slide highlights a few things that are leading to some volatility. One is the third quarter earnings season essentially started today. We're going to hear from many companies over the next 3 or 4 weeks. We do expect many of our companies to do quite well. There have been increasing prices, and those price increases are going to help revenue growth, margins, and cash flow. Many of the companies, given the volatility in the market, have very low expectations. So we don't exactly need to see a huge outperformance to see fantastic results in the stock price. So we've seen a couple of those today where the results have been good and the stock price has been great. So we do expect that could continue. In response to 40-year high inflation levels, the Federal Reserve has increased overnight rate 5 times so far this year to roughly 3%. This has had a number of impacts. One of those is it's strengthened the U.S. dollar to near an all-time record as foreign investments are attracted to U.S. higher interest rates. If all else were equal, this should pressure commodity and gold prices, as those are global commodities priced in dollars. So as the dollar strengthens, that could be negative for those commodities. Of course, all else is never equal, and this time it's not either. Global energy policies and geopolitical tensions are leading to higher energy prices globally. Gold prices are down. However, crypto prices, which is a new asset, are down even more and have fallen roughly 70% this year, despite those two being supposed inflation hedges. The higher interest rates have led to higher mortgage rates, and that has slowed the pace of home price appreciation. Eventually, this will lead to a slowing of the growth of the shelter component of the inflation CPI report, but this does tend to work on a lag. So currently, shelter is adding to inflationary pressures, and we talked a lot about that on our summer webinar. So if you want to dig deep into that, that would be a good resource. It has also inverted the yield curve, the Fed interest rates, as the 2-year Treasury note yields more than its 5- and 10-year counterparts. It also has increased the odds of a recession. We actually believe we entered a recession at the beginning of the year. Some economists might believe that we are just entering a recession. Some believe that we might enter one Next year, the way these things are timed now is we likely won't know officially when the recession began and ended until after it's already over. So it's not particularly helpful for real-time investment decisions. It doesn't really matter whether we're in one now or will be in one soon. Combined with a land war in Europe and the recessionary fears and strong dollar, all these events have created asset price volatility and poor investment returns in nearly everything so far in 2022. However, it's very important to point out and remember that it's normal for the market to bottom with lots of negative news and negative sentiment. And this way it's said, when the market rebounds, it climbs a wall of worry. So we do expect this rebound and climbing a wall of worry to occur relatively soon. We have the next slide on inflation, and we've updated this for today's reports and yesterday's PPI. So the Wednesday's PPI increased 8.5% versus the same period of last year. Today's CPI increased 8.2% from a year ago. If we exclude food and energy costs, so-called core inflation, which is what the Fed likes to focus on, increased 6.6%. This is the highest reading in over 40 years. So the Fed's intended impact of slowing inflation by raising interest rates has yet to show up in the inflation numbers. We do believe that the largest percentage gains in headline inflation are likely behind us. The overall inflation rate, however, is likely to remain elevated, well over the Fed's 2% target for some time. Food and energy costs are likely to remain high due to geopolitics and supply-demand dynamics. And the Fed has little control over those markets with interest rates. Those things are priced outside of interest rates. Probably the biggest thing the Fed can influence is the shelter component by cooling the housing market with higher mortgage rates. However, as I mentioned earlier, this will work with a lag effect, as rents are typically only changed once per year. And so those upward trends tend to be very sticky, as well as downward trends tend to be sticky, but we have not entered a downward trend yet. I would like to point out, looking at the chart, the year-over-year comparison for both the CPI and PPI does begin to face easier comps from October onward. If you look at September of 21, the blue line was kind of flat with August, July, and June, and then started stepping up in October and November. And it was November of last year where the Fed began to come to the realization that their transitory definition of inflation was no longer appropriate. So we do think in the short term, the comparisons will get easier, which should make the year-over-year headline number lower than it otherwise would be. In the next chart, also about volatility, many of you will recognize the way this chart looks with the bars and the dots. We typically show this chart, I like to include it for the S&P 500 index. And I think most are aware that the S&P 500 has been volatile this year, ending the third quarter down roughly 25%. The NASDAQ ended the third quarter down roughly 23%. And while those pullbacks are painful and we don't like them, we would consider those somewhat normal within the equity market, so that it's not highly unusual to get pullbacks. But we did here want to point out the volatility of the bond index. So going back to the mid-1970s, we have never seen the aggregate bond market lose as much value in 1 year. So we're down 15% when the prior high was 1980, down 9%, and it was unusual to be down more than 5% in bond prices. So we began the year with rates at 0%, since we were in pandemic emergency mode. Bond prices really did not have much room to increase. They could really only go one way, and they have. So bond prices have fallen meaningfully. So for those investors that do need, want, or have bond exposure, it's important to keep a ladder where your bonds are maturing and giving you principal, and keeping that relatively short. So keeping the maturities of those bonds maturing in the near term. In the next chart, we're going to talk about the consumer sentiment. and the gray line here is the University of Michigan consumer sentiment. So that's what the chart is depicting. There's shading of gray during recessions, and there's blue dots, which indicate peaks and troughs. This goes back to 1971, and as you can see, the consumer can be fickle and moody, and those moods can change quickly. Interestingly, during June of 2022, so 3 months ago, this index hit the 50% level, indicating that the consumer was the most negative it had been in the history of the survey. We believe this is an extraordinary time, given challenges like the Vietnam War, inflation in the 70s, the September 11th attacks, and the global financial crisis, that this June the consumer felt worse than it had during all those periods. We believe inflation was the likely cause for the negativity because it hurts nearly every consumer, not just stock owners or not just real estate owners. It hurts everyone. Importantly, the index has risen slightly in July and hit 58 in September. So we are 3 months past the bottom in consumer sentiment, if that holds. This is very important because the forward 12-month returns of the stock market are generally very positive 12 months after a consumer sentiment bottom. So the blue dots on the bottom of the chart, the 8 sentiment troughs, we have an average 12-month forward return of 24.9%. So when everyone feels terrible, it's a good time to buy. On the other hand, at sentiment peaks, the 8 sentiment peaks on the chart, we have a forward return averaging up 4.1%. So all else equal, you would prefer to buy when consumer sentiment is weak and prefer to not be as aggressive as consumer sentiment strengthens. This makes sense, even though it might seem counterintuitive at first, as the market tends to be lower during these tough times, and the market does very well in the early stages of a recovery. So of course we won't know until we get more data behind us, but in short-term moves in the market are always very unpredictable. If we were just focused on this one piece of information, we would think that the next 9 months would be very strong because those would include the 3 that have already gone, and for the 12-month return to approach 25%, we'd have to have a nice move short-term in the market. So we certainly do think that's possible. And now I'll turn it over to Scott to talk a little about some positive things in the midterm elections.
Thanks, Mark. So in the short term, for the rest of the year, there's some economic factors that we're going to need to keep an eye on. And that, as you see at the top of this page, Fed reassessment. So the question is going to be, is the Fed going to pause, let their rate hikes work into the system, or are they going to continue to increase at the increments and pace that they started in the spring and summer? And that's really going to depend on inflation, but it also is going to depend on employment and wages. Right now, we're experiencing very low unemployment. The labor market just last week indicated that it was still very strong, adding 260,000 jobs in September, which lowered our unemployment rate to 3.5%. To put that into context, since 1948, the average unemployment rate has been 5.74. A strong labor market gives the Fed permission to continue to raise rates. However, there is some signs of it slowing a little bit. New job openings are starting to decline, which will suggest that the labor market is definitely cooling. Wages are up, and we've talked about this the last couple of webinars and in our newsletters. Our hourly employee workers have increased, but they're starting to decelerate. But it's still high because companies are competing for labor. But with the recurring inflation, it's not enough to offset the pain that they're feeling right now because they're having to pay much more for food, energy, and shelter. With all this said, as Mark just said, earnings growth we just started it today, and earnings growth since the beginning of the year through the end of the third quarter has been up roughly 5% this year, while PE multiples have dropped on average nearly 30%. So what that tells us is that valuations are much more attractive than the beginning of the year, and as Mark indicated with the consumer sentiment, this might be the opportunity to start looking at companies and buying and investing. Next slide. So we got midterms coming up, and we've already had a couple of questions about it, so we wanted to address it in the webinar. Midterms are also causing market uncertainty, and they typically do up until the elections. And it can be a choppy market. But past history shows that the markets turn positive after midterms. So if you can see the gray box down at the bottom to the right of the bars, what you'll see is the average one-year return after mid-year elections has been 15%. All other years has been 7%. And the reason is that the president's party typically loses seats. In fact, since 1934, that's happened every time except 3 times. And the changing of these seats creates gridlock within Washington, D.C. And when fewer bills get passed, businesses feel more comfortable and prefer it because it allows them to plan longer term. So I'm now going to pass it over to Tim.
Well, thank you, Scott. As Mark and Scott stated, the economic backdrop has been rather negative and full of uncertainty. We believe we're in a recession. The classic definition of a recession is that economic growth adjusted for inflation is negative, and it's been that way since January 1st. So if it's that way for 2 quarters, under the old rules, that would be a recession. There are other factors people are looking at in recent years. And so in a few years, the economists will let us know when they think we entered recession. But since 1950, the average recession has lasted about 10 months. And then the subsequent expansion or growth of the economy has lasted around 69 months. So usually the economy is growing and the recessions tend to be less than a year in length. Well, every recession can be different. What we're doing on this chart is looking at the previous 72 years and taking the average of all recessions. And so when we do that, we show the average recession starting at the red dot in the middle of the page where we're at the 0 mark in months. And that line, the economic line, is in a teal, light green, or light blue. And what we see the S&P 500 index in dark blue. That tends to peak about 6 to 8 months before the recession starts. And the stock market then tends to bottom 4 to 6 months after the recession begins. So the bear markets can last about 12 months. Well, the indexes are off. The S&P 500 peaked in January and is down 25% from those levels. The NASDAQ peaked last November and is off 39% in the last 11 months. Well, bear markets tend to end in the middle of recessions when all the news is negative. And then the best market days tend to closely follow those market bottoms. Since it takes economists years to pinpoint when the recessions begin and end, what can a disciplined long-term investor do? Timing the market is rather hazardous. Many investors, using normal human emotions, exit near the bottom in a panic. And so normal human emotions are an investor's worst enemy, while long-term compounding is an investor's best friend. These are 30-year charts showing the power of compounding. They all start with $10,000 to invest. On the top chart, if you invest $10,000 in large capitalization stocks and spend all the dividends each year, then at the end of the 30 years, you have $92,000. If you reinvest the dividends and don't spend them, then the $10,000 would grow to $167,000. The bottom chart adds small capitalization stocks, bonds, and inflation. Small cap stocks do provide the best return on this chart and do so on most long-term charts. In this case, the $10,000 grows to $249,000. While the small caps tend to win long-term competitions against the other categories, they've lagged in recent years as the mega cap stocks dominated most of the last 10 years. And this makes them a rather attractive entry opportunity. Now, most of this 30-year period experienced low inflation levels, but inflation's picked up. And in order to preserve wealth, a portfolio needs to outpace both inflation and withdrawals. And we take that rather seriously. Our job is to preserve wealth long-term, grow it, and generate cash income in many circumstances. So three takeaways from this chart. First, it's best to not allow normal human emotions to drive exits at market bottoms. Dividends are very powerful, and there are benefits into diversifying into some small and mid-capitalization stocks in addition to the large caps. On the next slide, we see that in periods of higher inflation and rising interest rates, it's important to invest in firms generating excess cash. This provides the firms with lots of flexibility. Less than half of the listed firms on the exchanges generate free cash flow. We're focused on firms that generate excess cash flow and have growing streams of future cash generation. Many of these companies don't like paying higher interest rates, and as debt comes due, they can pay down their debt instead of refinancing at much higher rates. They can return money to shareholders in the form of dividends and share buybacks. They can use this market weakness to take advantage of opportunities and make accretive bolt-on acquisitions. As some of our firms have said, they've also moved from just-in-time inventory to building strategic inventory piles to compensate for supply chain disruptions. Now, similar to the trend of most companies burning cash, most companies are going to see declining profit margins on the next chart. And they we'll see expenses growing faster than revenues. It's important to be in companies that with expanding profit margins. Many firms have earned very, very little on cash balances and reserves, including financial firms, but financial firms have huge cash balances, and as they start earning interest at increasingly higher interest rates, that will greatly help their bottom line. With processing firms, inflation is increasing the sizes of transactions, and that increases their revenue, and their costs don't tend to grow as fast. Many firms with fixed costs, such as existing infrastructure, manufacturing plants, and equipment, might not see those costs rise, but they're able to increase their product costs, their product prices. Some natural resource firms operate differently in different cycles. Examples of gold, lithium producers, some natural resource companies with negative carbon footprints. Some of these can do quite well in this cycle. There are companies with patent revenue that have that revenue rise as contracts renew due to increased consumer product content of their products, technological advancements, and inflation adjustments. Most of these companies don't see their expenses rise at the same rate. And then we expect more healthcare advancements as phase 3 studies have been restarted post-pandemic. And we should start seeing positive outcomes from some of those in upcoming years. In recent years, the pandemic investors focused on mega cap technology stocks and alternative investments, ignoring other healthy firms. Some of these other firms are currently providing exceptionally attractive investment opportunities because the broad sell-off has affected most stocks, and the sell-off has been indiscriminate. So there are many compelling entry points. So we're investing in companies that should benefit from today's economic environment, a recurring compounding of future earnings growth. They're generating excess cash to fund their future expansion and shareholder returns. We believe our companies will have higher future valuation multiples. So while some indexes are dominated by expensive mega caps with slowing growth and declining valuations, we don't have to own those indexes. We are excited about our individual company outlooks and their future growth potential. So now I'd like to turn it over to Scott for questions.
Before we get to questions, we just want to thank you for attending today's webinar. I know we had one question already that asked if the slides would be available. We will be putting this up on the website. Everybody will receive an email indicating that it will be up on the website. If you would prefer a PDF of it, feel free to email any of us and we will email it to you directly. And again, we thank you. And we often get clients referring their families, members, and friends to us, and we greatly appreciate it. Those are the best compliments and best clients we can get. So if you know of a family member or a friend that we could help, please have them contact us. So now with the Q&A, the first question is, and Mark or Tim, I don't know which one wants to take it, but the question is, I know you two in particular are in constant contact with the management team at the companies that we invest in. And so the question is, what are the companies you invest in telling you about their business environment?
Well, each company can tell us different things and tell us how they're handling it. And that leads us to ask the next company even better questions. Some companies see a slowdown in one part of their business, but an acceleration or strength elsewhere. Some of our companies experienced weakness during the pandemic years, and now they have some segments that are rebounding. Some of our companies are opportunistically building inventory to offset the sporadic supply chain disruptions. And just about all of our companies are generating lots of cash. And they're tempted to pay down debt as it comes due because they don't like paying higher interest rates. And many of them are also repurchasing stock at these levels. They can't tell us while they're doing it. They can give indications before and they can tell us after. But knowing our companies and knowing those managements, their track records and what their most recent indications are, we think we'll be splitting rising profits with fewer shareholders. And so earnings per share should rise that much faster for many of our companies. So we're really excited about what we're hearing from these managements. But the smaller the company, the more nimble and agile and opportunistic the behavior. So we like what we're seeing.
Okay, the second question we have is, do you think companies are going to cut their dividends, start cutting their dividends?
That is a relatively easy or short answer, and I would say no. We do not expect to see dividend cuts within our portfolio. If we did begin to suspect that a company might be in a position where they have to cut their dividend, we would hopefully get out of that stock and not be in it. In fact, the opposite, we had some great news on one of our companies this morning, increasing their dividend. I think the number was 1,900%. So it was off a low base, but it was a big percentage increase. We also had a company that reported earnings this morning, buying back 2 million shares of its stock, and they're buy back stock very opportunistically. So we do not believe that this upcoming recession or the recession that we're in is going to create such a headwind on the cash flows of these companies that they wouldn't be able to continue to pay their dividends. So we do think the dividends are very safe, and in a dividend-focused portfolio that we manage is now yielding above 5%. And Tim and I were talking earlier this week, and we can't guarantee that it's never been that high, but we don't remember seeing a 5% dividend yield on our portfolio very often. So that would indicate that prices are probably too low. So we think the dividends are safe, and the income being generated is safe.
Great. Well, we don't seem to have any more questions. Again, we want to thank you for joining us today, and I'll reiterate one more time, we will be putting this on the website, and we'll email it out to everybody to connect to our website in the webinar. And again, if you want an Adobe, feel free to email any of us. Again, thanks for joining us, and have a terrific weekend. Bye.
Thank you.